Okay, here's a strategy for beginners as well as advanced option traders. Most advanced option traders don't even know the strategy. So this is a good thing for you to learn, especially as beginners, because you do not have to think about anything except for a couple of things, and that's it. So first we're going to get to the Econo Day calendar. I like to use this particular one. Now they want to charge you for it, so we need to figure out a hack to get it for free, which is simply just go right here where it says today's U.S. announcements. Let's go ahead and click that. Now I'm in it. So here I get weekly, here I get monthly, and there's a few things that you get if you decide to subscribe, but you really don't need to. You just need something to give you a constant reminder. Um, the red dots, so you can see right here where it says red star, yellow star, black star. The red stars are the market moving indicators. So where you see one of those, basically if you're a day trader, you don't want to be in the market right here because it's going to get very volatile. So you want to either be exiting the trade there or get in on the trade after the announcement happens. However, with this strategy, we're going to be getting in the day before, and we're going to be using what's called the FOMC. FOMC comes out basically on Wednesdays. You're going to get 8 of those per year, and the last one came out on February 16th. So let me show you with the FOMC. Okay, and there we go, FOMC, 2 p.m. Eastern Standard Time. So basically, you don't care what happens at this meeting, what they do, as long as they have the actual meeting. Okay, so now what the strategy is basically doing a simple on Wednesday, or Wednesday is when they actually announce it. Tuesday, before market closes, so Californians here, we're going to have to do this like quarter to one, 10 to 1, which is actually an advantage to you because this is lunchtime. So basically lunchtime, you just grab your smartphone and click, and you can actually make the trade because there's only 2 types of trades you can make. One is a straddle, the other is a strangle. Okay, now what I ended up doing here is going to this this is TD Ameritrade's strategy desk, and it just basically has a chart there. But I kind of want to show you, just going back a few months, using the FOMC and the getting in the day before, showing you exactly what could happen. So basically the option on Wednesday or Tuesday at close of business for Wednesday, it's going to be pretty cheap even for the S&P 500 or for the SPY ETF. Normally what you're going to be looking for is buying the call roughly around 90 cents, maybe to $1.10, and the put round of it, we're going to say, so let's just say it's going to be $2, just for the sake of argument, $2 every time you do this. Now, if that's the case, basically all you need is for the stock, the ETF, to move either up $1 or down $1 to break even, and anything above that is basically a profit. So again, that's what I was talking about. You can have a lot of base hits, a lot of singles and doubles, and then maybe some home runs. So I did a couple of them, so let's kind of show you exactly what happened here. Okay, let's go to the first one here. Looking at July, so we went in the day before the meeting, and if you can kind of tell, day before the meeting was at 209.33, which had been the closing price, roughly the closing price. So we basically do our strangle, straddle, whichever one you decide to do, and I'll tell you the rules between why you would do a straddle versus a strangle. But it was about 209.33 when it closed. Following day, Wednesday, the announcement came through, and this is a short trade because you're going to be using a weekly option, meaning it's always going to expire on Friday. So one of the major things about people learning to trade options, like when do I get in, when do I get out, so it's already set for you. When do you get in? Right before the market closes on Tuesday. When do you get out? Well, it's going to force you out on Friday, so because the option actually expires. Now, as you can see, the basically high, and I'm not saying that you're going to reach the high, but it went up to about 211. So from 209.33, it had to go up to $1 to break even, and then after the dollar, it went up another $1, so you made $100 on this one. Now, so nice little base hit, a single. So we're going to do the next one, which is in August. Now, if you see August here, we're going to get in right before it happens, so that was going to be the 18th. The announcement was the 19th, or the release was the 19th. It was at 210, roughly 210, and it dropped all the way down to, in the 4 days, to 197. So that particular trade on that day would have netted you roughly about $1,200 on a $200 investment. Okay, so there's your home run. Okay, so let's go to Went and did October here. So on October, we're looking at roughly 206. And again, your 4 days, 1, 2, 3, 4. So you need to move from 206 to 207 or 206 to 205, whichever direction to break even. Got up to about 209 on this one. So again, that was $200. So let's just call that a double, okay? And so forth. So we can keep going on with this. Now, yes, there is volatility that does come in. You know, the S&P will get a little bit more volatile than other stocks, but which will increase the price of the option. But this is just for you to actually go back test this. Using the economy calendar, it tells you every single time the FOMC was actually met. So you can go back to 2014, 2015, 2016, and the first 2 months of 2016, and just do exactly what I did here. The last one we're going to go through here is on December, so this is right around Christmas. Forget about the Santa Claus rally and everything else you do here. This is basically waiting for the event. This is actually called event investing or trading or trading economic indicators. So this one here we have opened it, see we're going to close around 202. And we see here that on the next 3 days it went up to 208. So again, that was $4, need to go up 1, 3, so there's your triple. So going back for these 4 or 5 different events, you will see that you made money each time without using any indicators. There's no moving average. I didn't use any price volume or anything like that. It was just basically being in, and then you really don't care what direction it goes as long as it moves in direction. Also known as volatility trading too, because now you know exactly when this market is going to be volatile. Now just a little background on what's going to happen in the research that was done for this. Basically, when this event happens, volume increases in the S&P 500 or the S&P by 24.7%, 25% increase in the volume. That means shares being purchased or sold. There is an increase of 25%. Volatility increases 28%. So this is the reason this is, I'm not saying that it's not the holy grail, but you can see why you had these winners in a row and why some of the winners were pretty big and made for some good investing. So now, the easiest thing to do now is basically to figure out exactly how to remember this particular strategy. So let's go over how we can remember this. Okay, so in a nutshell, that's the strategy. Called the Wall Street Money Machine. I like to call it pay the lady, or if you're Rihanna, bitch better have my money. Whatever you want to call it, as long as you can remember it. So let's kind of recap here, and just to make sure you remember it. FOMC meeting in the market. So basically, go to the economy calendar, find out when the FOMC is meeting. And again, there's other indicators there, and I'm going to go through each one of those to show you which market that you can actually trade with an ETF. That'll give you the same results, or close to the same results as we just went over with the S&P 500. Enter the trade day before the meeting. That's Tuesday. So, and again, if you're in California, just, you know, Tuesday at lunchtime, you need to get your smartphone and enter the very simple trade. When I first learned this strategy, I was told not to use a stop. I'm not sure why they told me this, but basically place a 50% stop. And the reason you want it on each leg, that means on the call and the put side. And the reason you're doing it this way is because since you're entering the trade on Tuesday, there's going to be a time decay from Tuesday to Wednesday. Okay, but since the market doesn't, or it's 2 o'clock when the meeting actually happens, when you're going to see this increase in volume or the peak of it, basically what you're doing is basically recovering half, so you're not losing 100% on one side to have to gain so much on the other. So kind of think of it, you're helping your risk reward by putting the 50% stop, and as you should put a stop on everything. Use a straddle or a strangle. No verticals. Straddle or strangle, basically what you want to do here is simple. When you enter the trade at 12:45 or whenever when the market closes, if the stock price is in between the two strike prices, use a strangle. If it's at the money or close to being at the money, then you want to use a straddle. Very simple. And If you want to make it simple, just use a straddle each time, because the SPY is only 50 cents strike increments, so just use a straddle each time. The other stock that you can use for this is also VIX, which is a little bit less expensive, VXX. You're looking at probably buying an option on this one for both sides will run you about $1 or less on that Wednesday. And that's it. So hope you enjoyed this one, and if you have any questions, you can put them in the comments section on the bottom, and look forward for my next video.